2, 1. Welcome to the show.
Alrighty.
Been a great week. Well,
Yep.
I don't know if it's a great week for the market, but we've had a decent week.
It's a bear market, bro.
Yeah.
It's one of those weeks, just like every other week is going to be in this. This is, I mean, all bear markets are interesting, and this one, you know, you got wars going on, and the Fed trying to thread the needle. It's unbelievable, and try to mix in there. It's hard enough to try to figure out the direction the market is more likely to go than not, and then you add in the two TSP, two IFT moves a month.
All these restrictions we're always talking
stuff
about.
gets tricky. Yeah.
It does. Yeah. I don't want to be Jerry. I just want to be the guy over here with all the equipment.
It doesn't have to be hard. I mean, because like on the show, we do the 2-year weekly charts on the show, and it takes away the forest for the trees, basically. Right? It makes it very simple.
And that's the reason we do it, by the way. If you're listening to the show or new to the show or whatever, we pull back the lens because that's a lot more. It's easier to digest like that. Now, if you're a member and you get our weekly newsletter, Jerry goes all the way down the rabbit hole, right? I mean, you'll go in, zoom in and out and give lots more analysis so you can make better decisions and all that. But for the show, not so much. But still a lot of value in just pulling back and looking at that big picture.
The big picture is the most important thing.
Yeah.
Now, when you actually, I mean, at some point, you can look at the big picture. It looks great or it looks horrible, but you have to make a decision about when you're going to reallocate. And you have to do it by noon to get that day's closing price.
So therefore, you have to zoom in a little bit.
Yeah. To actually make decisions. Yeah.
But to understand the trend, the overall trends of the market, you can look at what we do here in the show, kind of zoomed out, to make some real, some decisions on a day-to-day basis. You got to zoom in, which again is what we do in the weekly newsletter.
Right.
Let's jump in there, man.
All right. So, weekly update show, 10 April 2022. Okay, so there's a lot of news in different facets of the world this week, but in terms of TSP, we got some new information about this transition, right? So we're going to talk a little bit about that first. The TSP transition, part of it is the mutual fund window, but there's a whole bunch of other features in there. And basically what we're going to go over is kind of the timeline of how things are going to happen and some things around that. Then we're going to look at on-balance volume and accumulation distribution line. Two things that I use myself that I don't usually add into the charts because, I use a ton of different indicators myself, but when I create the charts to put up on the show, I don't usually use these two, but we're going to talk about them. And then the bonus chart, is going to be a C-fund analysis of how we use those on-balance volume and accumulation distribution lines. And then we'll do the 2-year weekly charts. Okay. So this TSP transition, okay, if you go to tsp.gov, you do not have to log in, right? I have not logged in. I went to tsp.gov. I hit the banner at the top, and this is the page that comes up, okay? So you don't have to log in to get any of this information. So it takes you to the new TSP features. I did this on April 5th, so it was effective then. We're introducing all these new features to make your experience even better on TSP. You'll have all these things, flexibility in your account, yada, yada. But how to prepare, okay? What do we need to do to prepare for this transition? This is the link. You're definitely going to want to go to that. The most important thing right now, and there was a little bit of talk about it on Facebook this week, the dates. Some of these things are going to happen sooner than others. So a lot of you guys have some experience, at least in federal contracting, and I'm going to keep referring back to that, but the expected date of the transition starts on the 16th of May. Having said that, there are things that happened as of April 8th. So the 16th of May is really the first one. They're trying to ensure a smooth transition, adding these features, and they're going to suspend transactions and services, right? And you need to know which transactions and services apply to you and what the dates are for when they stop, okay? Definitely you want to see the full calendar and the key dates and the deadlines. I'm going to kind of go through a little bit of it, but you absolutely want to go to the site. The idea is that all the transactions, the help desk, everything gets suspended on the 26th of May. And the first thing literally that caught my attention was the restoration date is the first week of June.
Which means kinda. Ish.
Yeah. I mean,
that is totally government.
Yeah.
To me. It's like,
that's
we hope to have it done by then.
Our plan is to have it done by the first week of June. Yeah. I mean, I don't know. We're obviously a bit jaded. We've been in the government for a long time, and I ran an IT section, and I can tell you, at least in my experience, that it never ever is complete on the date that it was originally forecast to be complete.
I mean, the good thing is, I think, as all things considered, the fact that they're doing this over Memorial Day weekend.
Yeah.
Right. So there's already a 3-day weekend, and it's like that is a time, and we always what's the saying? Go away.
Yeah. Nothing ever happens.
Come back in May.
The government. Well, that's a finance thing, but in the government, like once Memorial Day happens, like nobody goes to work basically until after Labor Day.
Yeah.
That's when everybody takes leave.
Yeah. Unless you're in our old world where it's just never stops. But the point is that if you're going to pick a time, that's probably not the worst time.
Sure.
And the first week of June is that next week. So you're rolling into Memorial Day. Most people are kind of disengaged anyway. Yeah. And I don't know if you're probably going to talk about this, but like this is Conan's opinion. This is not Grow My TSP. I'll let Jerry speak for that in a second. I'm going to be out of the market. If I'm in the TSP, I'm going to be out of the market. Why? Because I can't change anything for almost a week.
Right.
I'm going to be out. Like, if you have no control. And if you read the fine point, it's basically like we're not answering the phone.
No, they're not answering
the phone. We're not answering the email.
Yep.
I don't care. They don't care if the website's broken. Like, no, nothing. You won't be able to do a withdrawal. You won't be able to do. Right. Now, big picture, who's going to do all that over Memorial Day weekend? So I think generally they probably pick the best time of any, except over like maybe Christmas. Yeah. Right, the best they could do. So, all things considered, I think they planned this at a pretty decent time.
Yeah, they have to do it. I mean, the upgrades are going to be really good. It's once it gets all settled out, there's going to be a lot of value there in the new functionality. But
we hope.
Well,
but
I'm still.
Let's get back in.
I'm waiting on the list of available funds. Like,
right, we all are.
That's.
We all are.
I mean,
I feel like they're not going to tell us until we get there, but we'll see.
Yeah, we'll see. All right, so they hope to have full access restored by the first week of June. Okay, so these are just some of the, I screenshotted some of the pieces from this. I'm not going to go through all of it. Again, you definitely want to go to the website. And here's kind of the important part for us, right? During the transition period, your savings will remain invested in the TSP funds you elected. Okay. However, to ensure smooth transition, we'll suspend account transactions, access to online tools, access to forms, and correspondence for a brief period, meaning however long in the first week of June. These transactions and services include the following. So all these things have different timelines. Okay. May 26th is when everything shuts down. But I'm pretty sure, I don't have it here. I'm pretty sure that the loan requests was the one that was April 8th. I think April 8th was the deadline that you could request to take a loan from your TSP. Okay. So if you want to change beneficiary designations, if you got to do a court order for something, all these things have different dates. So definitely go to the site and check it out. Okay. So the transition period begins May 16th. And I don't know why they put in this part of it May 16th. May 26th is the final deadline for all of it. But, okay, transition period begins May 16th, ends the first week of June. Suspension dates for each transaction type will vary. We just talked about that. So read it carefully in the calendar. We encourage you to consider whether this transition period will affect your retirement planning, especially if you were planning to request any transactions in the near future, right? This is the most important part. While your current TSP investments will remain active during this transition period, we need to temporarily suspend investment changes toward the end of the transition period, right? So beginning May 26th. That means you won't be able to change your investment choices during this brief time period. You should review your current investment choices and make sure they still align with your retirement goals. Keep in mind that once you've established your retirement goals, blah, blah, blah. All right. This is obviously what we're concerned about the most, right? And we're in a bear market, right? I'm not telling anybody what to do. I'm happy to tell you what I'll do. I don't care if the market is exploding higher on the 26th of May. I'm moving to the G fund because the first week of June, if it happens, awesome. If it doesn't happen, you have no control. You can't get out. This is the only time in the past since TSP started in 1986
that there's
or whatever,
been a halt in trading.
There's been a halt in trading, yeah. So you can't, it's bad enough, right? The 2 moves a month is bad, but at least you can always go to the G fund if you want.
Yeah.
You can't
even
get
go
out.
to the G. Yeah.
We're in the middle of a bear market,
Right.
and there's going to be a week or more that
and
you
have
can't
no
get
control
out.
if there's a reemergence of COVID or
Another war.
Yeah. And again, you won't know why, and it doesn't. And to us, it really doesn't. Never really matters why it happened.
Right.
We only care that it happened, and the fact that potentially over a week or so, right, ish, if my account went down 20% for some reason, and there's nothing I could do about it.
Yeah.
Oh no, I'm out. I'm in G.
Yep.
I'm going to go to G and enjoy Memorial Day weekend.
Yep. That's exactly my plan.
Yeah. And we're not advising anybody to do that. So don't take that the wrong way.
No.
We'll give the disclaimer.
I mean, the market might go up 10 or 20% during that week.
And I won't get it. And I'll be very happy, that I was not there if it went down. I mean, I wouldn't even be willing to take a 5 to 10% loss because I have no control, right? I mean, no.
That's the thing. The lack of control is the problem.
Yeah. So you would have to watch it and nothing you can do. And, certainly people can say, well, we'd sue, we'd do this. And I'm not going to have a need because, again, Conan's going to be in the G fund.
Yeah. Yeah. I mean, do what you want.
Yeah.
You might also add to that the idea of the sell in May and go away.
Yeah.
Right?
And mostly I would just say, do whatever makes you sleep well at night is always our recommendation, because we don't know your personal circumstances. We don't know what you're trying to do. All I'm saying is, regardless of whether I'm brand new to the government, in the middle of my career, at the end of my career, if I knew for over a week-ish that I couldn't touch I couldn't reallocate at all, there's no way I would be in the stock funds with no control.
Right.
I would be in my money market. I'd be sitting in the G fund, and I'd be pissed if I missed, a great opportunity. Sure. But I would be way more pissed if I lost 20% of my retirement because this just happened in that time frame.
Sure. So, and there are plenty of people that'll the other side of that is going to be it doesn't matter what happens. I'm going to stay invested in the stock funds because the market always goes up. And
if you're a buy and hold person, then why would don't
even listen to this conversation?
First of all, I always question that if you are a true buy and hold person, why are you even listening to our show? Not that we're against buy and hold. It's just that means that you are not going to change your allocations. Right. That means then why wrap yourself into this? Right. Get about your day, and it's going to happen because you're generally correct that the market is always going to go up until it doesn't. Right? There's that new country song that I listen to every time it comes on. I'm not a huge country fan, but I do listen to country music, and it says, you always have time for that extra fishing trip until you don't. You always have time for that extra date with your grandpa until you don't, right? And so that's kind of how I look at the stock market. It's like, well, it always goes up till it doesn't. Anyway. We talk about that enough.
All right. So
let's get back to the transition. So I think for me, the takeaway is most importantly, anybody that's listening to this, go educate yourself. Go read the stuff that's on the website. See how it impacts you, because to you it may be the part that we're talking about going to the G fund may be the least of your worries. It may be that you decided you're going to do some particular thing in your financial life where you need to take out a loan in your TSP account for whatever reason, or you need to change something massive and you can't do it. So go to the website, check out the dates, be proactive.
Yep, absolutely.
All right.
Okay.
On to the next one.
That's about it for the transition for the time being. I'm sure we'll come back to it. So a couple tools of the trade: on balance volume and accumulation distribution line. So again, I'm getting this off of Investopedia. They call the tools of the trade, right? So we talk a lot. We use stockcharts.com, and the language here in Investopedia is very similar to how they do it in stockcharts.com. So tools of the trade for a day trader and technical analyst, which that's what we do, technical analysis of the price chart, consists of chart tools that generate signals to buy or sell, right? That's the point. We're trying to observe the signals that tell us when to reallocate either into the stock funds, which is a buy, or into the G fund, which is a sell. And we're trying to follow the trends, right? So broadly speaking, there are two basic types of technical indicators that we see on the charts all the time, and we're going to get to them later. There are overlays and oscillators, okay? An overlay is what's overlaid on top of the price chart. So it could be Bollinger Bands, it could be Fibonacci extension, retracement levels. Anything that's overlaid on top of the price chart is an overlay. Below the price chart, you can have MACD, RSI, on-balance volume, accumulation distribution. There's 50 different, they call them indicators. They don't call them oscillators. Some of them are oscillators, but the tab is called indicators in stockcharts.com. So they're all under the price chart. And the two oscillators we're going to talk about are on-balance volume and accumulation distribution. So traders often use several different technical indicators in tandem when analyzing a security. So here it says, with literally thousands of different options, traders must choose the indicators that work best for them and familiarize themselves with how they work. And we talk about that all the time. We only have so much real estate on the page here to show you guys. But again, there are 50 different indicators in the drop down on stock charts. And apparently there are literally thousands of different ones that you could find in other software if you wanted to. The idea is to find the ones that kind of make the most sense to you and that will hopefully lead the price chart, because that's what you really want. So traders may combine indicators with more subjective forms of technical analysis, such as looking at chart patterns to come up with trade ideas. I mean, we talk about that pretty much every week. Okay. So that's the idea. So we're looking at on-balance volume first. So on-balance volume, it's an indicator to measure positive and negative flow of volume in a security, or, for us, the stock funds, over time. So the indicator is a running total of volume, of up volume minus down volume. So when we show volume on charts, on an up day, volume is in black. On a down day, volume is in red. Up volume is how much volume there is on a day when the price moved higher, right? When the price rallied, and that's in black. Down volume is volume on a day when the price falls, and it's in red. So each day in the on-balance volume indicator, each day volume is added or subtracted from the indicator based on whether the price went higher or lower. So when on-balance volume is rising, it shows that buyers are stepping in and pushing the prices higher. When on-balance volume is falling, the selling volume is outpacing buying volume, right? Because all you're doing is subtracting the positive volume from the negative volume, right? So when on-balance volume is falling, it indicates prices are moving lower. In this way, it acts as a confirmation tool for the price chart. Okay. The most important one for us, and we're going to show it here on the next slide, is this idea of divergence. So I like to use on-balance volume to watch for divergence. It occurs when the indicator, the on-balance volume indicator, and the price are going in different directions. So if the price is rising, but the on-balance volume is falling, right, it means that price is going up, but the volume of trading on the upside is less than volume of trading on the downside. right? So if volume of trading on the downside is greater than the upside, then that line goes down. If price is going up during that time, it shows that there's a disconnect, right, a divergence. And it could indicate that the trend is not backed by strong buyers and is getting ready to reverse soon. Okay. I know I was rambling. That's why I like to have a chart in front of me to explain this. Okay. So this is the chart from the same link. Okay. So we had a top in price. The top is always the price chart, and these are the bottom are the indicator charts, right? So we're looking at only on balance volume down here. So we hit an initial price high, and we get a high in on balance volume. Price flattens out. On balance volume is basically flat. Price comes down. It's confirming what price is doing, right? We get to a high up here. On balance volume rolls over. That makes sense. At some point, price makes new highs relative to this one. We get a new high in on balance volume, but then on balance volume starts dropping off even as price keeps going higher, right? So what does that mean? When on balance volume starts falling over even as price is going higher, it's not a perfect timing tool, but it's telling you that price is going to roll over at some relatively soon time, because the market, people are selling more than they're buying, right? Even though price is continuing to go higher, the price is getting bid up. There's more selling than there is buying. That's what causes the divergence. And then at some point, it gets reflected in the price. So it's a leading indicator, okay? Accumulation distribution is similar, but it's talking about flow of money, okay? So either people are accumulating the stock or they're distributing the stock. You could say they're buying in bulk or they're selling in bulk. So it's similar to on-balance volume, but instead of considering only the closing price of the security, it also takes into account the trading range. So if a stock finishes near its high for the day, let's say, where we're doing a 1 year daily chart, if it finishes near its high for the day, the indicator gives the volume on that day more weight if it closes at the top of the day's trading range versus the bottom of the day's trading range. So because that calculation is a little bit different than on-balance volume, sometimes on-balance volume is a better indicator than advanced or accumulation distribution line, right? Or vice versa. So we're going to take a look at both of them. If the indicator line is trending up, it shows buying interest, right? Very simply, it shows that more people are accumulating if the line is trending up. Since the stock is closing above the halfway point of that range, which is the factor for accumulation versus on-balance volume. So it confirms the uptrend. On the other hand, if the AD line is falling, it means the price is finishing in the lower portion of the trading range. So then volume is considered negative and it confirms the downtrend. Traders use the AD line to watch for divergences. Again, that's the most important piece. If the AD line starts falling while prices are rising, it signals that you're getting to the end of a trend, right? Similarly, if price is trending lower and the AD line starts to rise, that could indicate that the bottom is just about in, okay? So here's what that looks like. So the indicator down here on the bottom is accumulation distribution, right? Price was falling. Accumulation distribution was basically flat. Okay, there's not too much information there. We hit a bottom. AD line starts going higher with price, as you would expect. At some point, the accumulation versus, so for in this, we have way more accumulation than distribution. And then it starts to flatten out, right? There's not as many people accumulating the stock as there is selling it. Even though prices continuing to go higher, there's as much accumulation and distribution are flattening out, okay? So this is the time when you start to look at it and go, okay, price is still going higher, So I'm still in the stock funds, but I'm aware that at some point we're getting close to a top. Okay. And then once the line starts falling, price starts falling. So it's an early warning. And the second part of this is actually better. It doesn't do as well anticipating a top as it does a bottom. So here's the low in this example for accumulation distribution. And that's back here at this low. Okay. After that, the market anticipates that the bottom is going to come in soon. So price keeps going down, right? But the market is starting to accumulate more than it's distributing. Even though price is still being bid lower, there's accumulation going on. So it's telling us that the bottom is close, right? And then we do get a bottom. Price starts moving higher, and of course, accumulation continues. So it's a leading indicator. Okay. So what does that look like today on the C fund? How do we use both of these indicators on the C fund today? So here's a 1-year daily chart of the C fund, right? I did it through April 5th. So accumulation distribution is flat, on balance volume is flat, price is going up here, that's fine. We have a little bit of a correction. It didn't do too much to either of them. As price keeps moving higher, both of the indicators keep moving higher, right? And we said sometimes accumulation distribution is a better indicator, sometimes on balance volume is a better indicator. In this case, on balance volume flattens out even though accumulation distribution flattens out even though on balance volume continues higher, right? So price is still going up, but accumulation distribution starts to flatten. So it's an early warning that, hey, we might be getting towards the top. And then once price started rolling over, obviously both indicators started moving lower. So we got an early warning back here that we were getting close to a top. Okay. Then as price comes down, we have a low. We come up, hit the resistance line, come down and put in a new low. But in on-balance volume, the lowest low was at the first wave down, right? This low here in price is this low in on-balance volume. And then it flattens out. It doesn't keep going lower, even though price does continue to go lower. So it's telling us that a bottom is probably coming up, and it did. But we don't get that indication in accumulation distribution, right? People continue to distribute into price, but volume was telling us that a bottom is imminent. So that's why you stack these indicators on top of each other. Price moves higher, on balance volume is higher, accumulation distribution doesn't move as high and starts to roll over, right? This is really the big one because both of these, accumulation distribution flattens out and on balance volume actually starts to decline, even as price is continuing to go higher, right? This on balance volume indicator definitely was a big divergence right there. So the timing wasn't great. It didn't tell us exactly when the top of the market was going to happen, but it told us it was coming up. So, and then you would put the other technical indicators in place, right? You would draw the trend line, and if you wanted to stay in the market, maybe you got out right there when it broke that trend line. But you had a lot of warning, is what I'm saying. So that's how you use these indicators. Okay. Does that make sense? Okay, good. All right.
Does to me.
Good. Sometimes I can't. I'm talking in my own head, and it's hard to, I get all kinds of feedback that I'm way too technical, and
well, they don't call it technical analysis because it's not technical.
Yeah.
I mean, I listened to you for a few years, glazed over, but once you take the investment, the education investment, to go down this path, you kind of have to every once in a while. And so, just so everybody knows, if you just starting to watch the show, or if you've been here around a while, I mean, I don't have a lot of formal education in technical analysis, and I mean, maybe Jerry would argue that he doesn't either. Formal is a weird word for these kind of things, because it's not like you can go to college and say, I'm going to get a master's degree in technical analysis. I mean, you can go into finance, you can do a lot of things, but technical analysis is one of those things, other than the CMT, the Chartered Market Technician, which is a very difficult thing to get, much like many other of the financial designators. Anyway, my point here is like, most of us who are going to do this are going to be self-taught in some way. You're going to have to be hungry for the education. And so it's no different than when someone's trying to figure out how to build their website nowadays, and they're not a computer programmer. Well, you don't really have to be a computer programmer nowadays to build a website. You don't have to be a market technician to know how to allocate the money in your retirement account either. What you do have to have an understanding of is some fundamentals. So when you go through the fundamentals, like some of us, that may just be like, right? But that's just the start of your journey, right? So take the time to kind of, let that soak in a little bit, and then keep watching, because as you start to put the pieces together, and I would recommend, I think at some point we are going to put like a list of books that we recommend on the website. I've always wanted to do that and just haven't gotten around to it, mostly because I feel like I'm going to forget some, or there's going to be some that I don't know, that I haven't run across. But, I buy a lot of weird books about financial analysis and technical analysis. If you're on my, if I could share my Amazon book list or whatever. But anyway, some of the books are just so deep in the weeds. It's hard, but it is what it is. They don't call it technical for nothing.
There's a lot of math behind all of it, and to be honest, I mean, I wasn't a math major. I was a political science major.
Yeah, I know. We're both social sciences guys. Yeah. I'm not a math guy. Like, I was pre-med and realized somewhere along the way, not going to happen, right? I'm a social sciences person. My brain works that way, and I think you are too. But that's only to point out that you're very proficient in technical analysis, because
I'm using the information. I don't have to do the math behind it.
It's practical.
It's an application of it.
Yeah, there's no math to be done. I mean, the software is doing the math. Right. You're just drawing the lines.
Yeah, if you can find indicators that lead, and then they all, unfortunately, that would be the crystal ball if all the indicators told you. So, I get all the time, what's the most important indicator? It's the one that worked in the market environment at that time.
Yeah, it's the one that spoke to you.
Yeah.
That gave you the information you wanted. And normally the answer is going to be not just one.
It's never one.
Yeah. It's going to be a combination.
It's never 100%.
Yeah. It's going to be a combination, and you got to find the combination that gives you about an 80% solution. Right? You don't need to be, you're never going to get a 100% solution. No. And sometimes I'm happy with a 70% solution.
If you were in Vegas and you had an 80% solution, you'd be the best guy ever.
Yeah. And the point is you don't need it to be that high if you're only going to be concerned with large market trend changes. Right. If you're trying to do this, on day-to-day basis, that's never going to happen with the TSP rules. Yeah. You need to be concerned about the large shifts in the trend, which you can easily do with some of these fundamentals. Yep. But no, I don't think we get too technical. If otherwise, what would we be doing this for?
Yeah. Yeah, it's interesting, because in the newsletter this weekend, I'm going to be talking about we're still on our plan A in terms of Elliott Wave, and even though, so my plan A is that we go to new all-time highs sometime, not time.
By the way, that's not because he's an optimist.
No, it's because I'm reading the
realist.
chart.
I mean, you're looking at the data.
Yeah.
That plan A is not because, I just want to point that out, because I mean, some people might say that, and that's the hope principle. Yeah. Right? Yeah. It's because I just hope it does. And that's not why. That's plan A. Plan A is not because we hope it goes up. Plan A is because all the data we've been looking at, and a lot of other people have been looking at besides us, says that this is the probability is we go back to all-time highs.
Right. So when I say my plan A, it's because of the Elliott Wave pattern, right? Since the low in COVID, the market's gone up in 4 legs, and we need that 5th leg to take us to new all-time highs. I say it's plan A because it's not guaranteed. But unless we get below the February lows, then plan A is still in effect. And anybody who's a subscriber to the site is like, yeah, but how come you're in the G fund right now then? And it's because there's long-term, you have to be able to do multiple time frames in TSP. So for the purposes of the show, we're going to the 2-year weekly charts. Okay. We talked about this chart a lot as the only chart that matters, and it still is. It's always going to be, honestly. It doesn't mean you can use this as the only thing that you use to make reallocation decisions. And if you do, you just have to accept that there's a lot of space, meaning percentage, gains or losses, if you make reallocation decisions on a weekly basis instead of a daily basis. So here we are at the bottom from COVID. Once we got above, and again, each one of these ticks is a week. Okay. So if you only look at TSP once a week, this is a pretty simple go by. Here's the bottom of COVID. We get above the 20-week moving average line. And once we got above it, right, we stayed above it. We got support at that 20-week moving average line every time we tested it until we broke through it in January. Okay. Then everything changed. Every time price tried to get back above that line, it couldn't do it until it did 3 weeks ago. Okay. So you want to be on the right side of the trend. After COVID, once we got back above that line, being on the right side of the trend, meaning you want to be north of that blue line. And if you were there, you made huge gains from whatever, April to May 2020. You stayed in the market all the way until January 2022, and you made huge gains because you were on the north side of that line. Once you got on the south side of that line, it's very risky, right? The trend, now the line becomes resistance. So now for the past 3 weeks, we've been above that line. So 3 weeks ago, if you were following this methodology, you could have just gotten back into the stock funds. And it's been on a daily basis, it's been up and down, but it's been basically flat, right? For the last 3 weeks, it's been consolidating and staying above that 20-week exponential moving average line. So if you don't want to get sucked into the weeds, just be in the stock funds when it's above that blue line. And that's the C fund. Now, the S fund, it's a different story, right? It's the same exact principle. Once we got above that 20-week exponential moving average line, every time we tested it, we got support all the way along, more or less. There's a little bit of, it's not perfect, but more or less all the way along until we collapsed below it. In terms of the S fund, it was last November. Okay.
Yeah, and let's talk about what happens when, those spots where you talked about how it tested it, maybe went a little lower, no big deal. If you're zoomed out enough, you can see that. Yep. And when in doubt, again, if we're zoomed out this much, and this is the way that you're managing your retirement account over 30 years,
yep,
just give it a day or
yep.
two, right? Because if you're big picture, don't stress too much. Now, if it goes way below that line, like Jerry's getting ready to point out, like that didn't take a few weeks to figure out. Right. That took a few days to figure out, and you knew, and it was definitely below that line. Then get out. I only want to point that out because if I'm watching this and I'm not as in tuned, and I haven't, I'm just starting out kind of watching this, and I'm like, then I should have gotten out like 5 times there, right, as those little tick marks came down. If you'll point them out on the, I'm pointing at the screen, but I don't have a. That's a good point. Yeah, those little spots there.
So like, what that is,
zoom in there if you can.
Yeah. So what that is, these are candlestick. This is a candlestick chart, right? And so what the candlestick tells you is, in terms of the one that we're pointing at there, you have that red rectangle on top, right? That week, the market opened at the top of that red rectangle. It came all the way down to the bottom of what's called that wick, right? The thin line at the bottom. Mm-hmm. That was the low price for the week.
But it closed
at the bottom of the rectangle.
Which means it's still above the line.
It closed above that moving average line.
Yeah,
right?
And so what I tend to tell people who are new at this is don't use candlesticks.
Yep.
If you're going to zoom out that far, Now, the candlestick gives you a lot of information. And so as you learn this, use the candlesticks for sure. If you understand candlesticks, then use them. But again, I didn't want to fly past it and people see how it came down below. Actually, it didn't, right?
On a weekly basis,
On a weekly basis, it didn't. It tested.
Intra-week, it did.
Yeah. And so what you'd want to do is you would just do a line version of that, and you would clearly see that it didn't until, as Jerry pointed out.
Until right there.
Bam, right? That line, if that was a line instead of candlesticks, it would have just gone hard south.
Straight down.
And then you'd have been like, I'm out, right? So only pointing that out to kind of give some perspective to it. We use candlesticks because there's so much more information, black versus red, the wick, that's a lot of information in one little graphic. So as you learn that and can wrap your head around it, please use them. But if you were just to use that chart, and only use lines instead of candlesticks, you could just say to yourself, hey, when that line crosses, I'm out.
I think last week, I'm pretty sure it was last week, we did the same chart with dots. So if the line is a little bit difficult to follow sometimes, but if you use dots on a weekly chart, then the closing price for the week is the dot, right?
Right, and it shows you if the dot's below.
If the dot's below, it's below. If it's on the line, give it another week.
Exactly, and that's what you just got to be willing to do. And honestly, I tell people all the time that are just like, man, I just can't do all this stuff you're talking about. And I'm like, can you look at a chart once a week?
Yeah, that's all it is.
That's all we're asking. If it's on the line, give it another week. If it's below the line, maybe give it another week.
Maybe.
But I would probably get out because that's going to basically equate to 4 times in a month that you potentially could make a move. And you're probably not. More than likely, you're going to be able to use those 2 moves a month over the course of 30 years, and you don't need anything else.
Right.
Like if people could but nobody's willing to just kind of let it go after that.
Right.
Most
Once you
people
get into
aren't
it,
disciplined enough.
Right.
Because we want to know more, and that's okay. There's nothing wrong with that, because I would say that as you zoom in, there are lots of opportunities for you to take more advantage of that volatility. And so if you really want to milk everything you can out of your retirement account, you do have to zoom in. You do need to make a few more calculated tactical moves. That's how we do this. And then, when we share our alerts, really it's supposed to just validate your decision. So if you decided to wait another day because of whatever, and you see that we moved, you can go, okay, well, let me validate my decision against that. It's just like the teacher giving you their answers. There's not that's the way we play the game. But if you're brand new and you're just trying to wrap your head around all of this, use these charts that we show every week and think to yourself, okay, I'm in, I'm out. It's pretty simple.
The tough part is, for example, this one right here. It's a big percentage move over the course of the week. So at some point,
so that's going to scare the crap out of you.
Yeah. So at some point, let me just see if I can zoom in here.
But where would the dot be?
The dot would be right there.
Exactly.
Yeah, it's at 2100.
Wouldn't look as vicious.
Right. No, it doesn't.
Yeah. If that dot was there and that's what you looked at on Saturday or Sunday,
right, then it's no problem.
You're not gonna be stressing.
No, the problem is when you walk by the TV in the office and the market's down 2% or 3% at 2:00 in the afternoon, and
don't look at it till Saturday.
Yeah.
Saturday are for the charts.
Yeah, that's right. Weekends for the charts. Go wear the T-shirt.
Go in there on Saturday, see what happened for the week, make your decision for the next week.
Yeah.
If you do that for 20 to 30 years, you're going to be massively far ahead in your retirement account. You're going to have managed it well.
Yep.
Now, if you want to milk every little percentage out of it, then you got to zoom in.
Yep.
There we go.
All right. So back to the S fund. So let me just go back to the C fund real quick. The C fund, for the past 3 weeks, has been above that 20-week moving average line, right? Let me go one step further and say that the wick here and the wick there got above the line, but the close did not. That's showing that line is resistance, okay? This week, the high wick, and we closed at the bottom part of the trading range. Yeah. We closed in the bottom part of that trading range, right? So that's not a bullish. It's a bearish candlestick, is what that is. So it makes sense that the following week is negative. Now, the following week is negative, and it's down, 1.11%, but it's still above that the blue line, right?
Yep.
And in general terms, it's basically flat from the first of the 3 weeks where you theoretically got back in at. So
yep.
You have to be, if you're only trading on a weekly basis, you have to allow a pretty good percentage move and not freak out about it.
Yeah, if you're zoomed that far out, you can't be stressing over 1-2%.
Yeah. No.
And the good thing is if you're doing this on a weekly basis, you're not going to. Now, let me back up a little bit, right? So how long did it take in the COVID drop? How long did it take for that to happen? I don't remember the time frame. When you're always showing that chart of how long did it take for you to see that it had gone below, and then we got that like 20 or 30% drop. I'm not explaining it as well.
I'm not 100% sure what you mean.
Yeah, but it dropped pretty hard.
It did.
It dropped
really
pretty
fast. Yeah.
So could you have taken a week off from that and not?
Oh, I see what you're saying. No.
Yeah.
So we got out literally 2 days before the first move down in COVID, and it was because we don't trade on a weekly basis. We trade on a daily basis.
Yeah. So
yes.
we were able to miss that. Now you still would have missed part of it.
Yeah, for sure.
You would have taken a hit. So that's why, of course, like I said, if you want to get everything you can out of this,
right.
you want to play it a little bit more zoomed in on a daily or weekly basis.
Yeah.
But if you're saying, listen, I don't want to do that, I don't want to deal with that, well then the weekly basis will work for you. Yeah. And because the market does generally go up over time, especially decades, then it's going to work out well for you.
Yep, 100%. All right. So I only wanted to flip back because the C fund is still above the 20-week exponential moving average line. Don't forget relative strength. It's just barely above 50.
That's why we have more indicators than one.
Yeah. So yes, it's above 50, but it's not above 50 by much.
However,
and yes, we're above that 20-week line, but we're not above it by much.
Yeah, we're not in the market.
No. So S fund, same kind of thing. Once it dropped below that line, came up to it, resistance, and then this week, it's continuing to roll over. So the next big question mark, honestly, on this chart is, do we get a close below 1800, below these lows right here? The relative strength couldn't make it up to 50 and is rolling over. So clearly you don't want to be in the S fund on a weekly basis at this point. I fund, same thing. Resistance there. This week rolled over again. Couldn't get above 50 on the RSI, and it's angling down. Had a really big 1 week recovery rally right there. It would have been great to have gotten those gains, but to have gotten those gains, you either had to be in the market back here and absorb that loss so that you could get those gains, which obviously is not valuable, or you had to guess that this was the actual bottom. How you would have guessed that that's the bottom, I haven't the slightest idea. If you did, awesome. I don't remember, at some point on the show, I pointed out this gap. So what is that? 65, 62, so somewhere around 63. If we had gotten down here to 63, let's say, that would have been, if you were aggressive and you knew that, hey, the markets tend to fill the gap. So it filled the gap. If price had gotten down here, filled the gap, and I'm going to get in because I think it's going higher because it filled the gap. That would have been a reasonable understanding of technical analysis, and you could have, am I down one? No. You could have gotten in at that point and gotten that gain. That would have made sense to me. But barring that, there's no reason to think that this was going to be the low. So if you guessed, good on you. But it doesn't look good right now. All right, the only thing that looks worse than the stock funds is the F fund. And of course, this until, let's see, it was all interesting. This part here, this part here was interesting, But once the Fed came out on January 6th and told us that they're going to start raising rates, that was that.
That's it.
And it
came over.
They told you the market's going lower.
They told you the answer because that correlates directly to now.
Fund.
Yeah, as I look at this chart, and we're talking about how so this is still 2-year weekly, right?
Yep.
Yeah, but if you were to pull back even farther, that's just going to look like a consolidation. That other piece, not the big drop.
Yep.
It's just
the other piece.
Yeah, the other as you back off there, that's going to look like almost a straight line going across.
Yeah, the consolidation is fine.
Yeah, it's where that big dip. Yeah. And is it going to look that big later? But the point is, we wouldn't be in the F fund anyway, right?
Right.
But no reason to be anywhere near the F fund. And most people would say, well, there's no reason to ever be in the F fund.
Oh, that's not true.
And I always say, go back to our website and look at 2018.
Yep.
Because we did use the F fund effectively, and we beat the market.
Yep. So in the newsletter,
and I don't mean we beat the F fund.
No,
we beat the market.
Yeah. So
and the F fund was only part of that, but it was because of it.
Yep. The newsletter this weekend, I have 2 charts that I pulled off somebody on Twitter. The F fund right now is down like 7.5% for the year. If it was to close, if it closed the year where it is now, down 7.5%. The charts that I put up go back to 1977. It is by far and away the worst year. If it was to close this year at this level, it would be by far the worst year for the F fund since at least back to 1977. And so the newsletter actually this weekend is going to be pretty interesting. And a lot of it is about the F fund.
It's always interesting.
But yeah, so a couple of things to point out, I guess. Generally speaking, when you get below 30 on the RSI, you have to start thinking you're near a bottom. Okay. Much like when you get up above 70, you have to start thinking like you're near a top. But the relative strength can get up above 70 and stay there for a long time, and price can keep moving higher. Okay. So just because you get up to 70 doesn't mean, like in this case it did. It rolled over right there. And in this case, it wasn't below 30 for very long and it started moving higher. That's not always the case. You can see down here, we got below that 30 line in the middle of January. So that was what, like right there. If you bought back in thinking that the market was going to immediately start moving higher like it did back here, you took that whole loss. It has to turn back up and ideally get back above that 50 line before it's worth buying back in. All right. That is all I got.
Questions.
Maybe we'll get some questions on this one. I don't know.
As always, if you have questions, put them in the comment section wherever you find this. If you watch it on our website and there's no comment section, you can always send us an email.
Yep.
At info at I almost said info at CrossFitandPavis.com. Info at growmytsp.com. CrossFit and Pavis used to be our CrossFit gym. Yeah, it was another life ago, a long life ago, seems like now. But yeah, so give us some comments if you do on YouTube or Facebook, wherever you find this. Generally on YouTube, it does take us a few days to get back to it because we don't just watch YouTube all the time, and it eventually gives us a notification. But we'll always try to answer, and at the very least, shoot us an email if it's a specific question about your personal circumstances and your, what should I do because I'm this. We're probably not going to answer it, at least not directly, because we don't know your personal circumstances, and we're not trying to be your financial advisor.
Yep.
So with all that said, if you liked it, share it with your friends, let people know.
Yep.
And we will see you here next week, same time, same bad channel.
There we go.
Let's get out of here.